You know crypto adoption is real when even the banks are getting on board. Now, understanding how they view cryptocurrency is key, given that banks still hold most of the money. Bank of America recently released the most comprehensive report on cryptocurrency from an institution to date, and its key findings are what I'll be going through today. Before we begin, there's a disclaimer you need to take in. Financial advice is not my thing. Education is what I sling, so contact a financial advisor for help with your bling. Now, if my rhymes are melting your mind, it must be your first time stopping by. My name is Guy, and making crypto content is my way of getting high. Coins, tokens, news, reviews, exchanges, tutorials, and more. There are over 500 videos for you to explore. If you want to make sure you get these videos while they're hot, subscribe to the channel and ping that notification bell to secure your spot. It's dangerous to go alone, which is why I've left some timestamps down below. You can use them to skip around if you're in the middle of a quest, but watching until the end is always best. Now, I know this disclaimer was pretty dank, but it's nothing compared to what's in the recent crypto report by America's second largest bank. The report I'll be unpacking today is over 140 pages long, and I reckon it helps to understand how it came to be, especially since Bank of America has not always been bullish on cryptocurrency. For example, one of the bank's most senior analysts said the crypto bull run was, quote, the mother of all bubbles in January this year. In March, another team of analysts issued a report bashing Bitcoin on the grounds that it was too volatile, too slow, uses too much energy. You know, the usual FUD. This seems to have changed in April, when JP Morgan introduced a Bitcoin fund for its high net worth clients and began investing heavily into crypto companies such as Consensus. For those who don't know, JP Morgan is the largest bank in the United States, and with Bank of America as the runner-up, it was only a matter of time before it followed suit. In May, Bank of America partnered with stablecoin issuer Paxos to optimize its stock trade settlement times, and later joined FTX and Coinbase Ventures in a $300 million investment round. In July, Bank of America's crypto aspirations were brought to light as it announced the formation of a dedicated crypto research team. As you might have guessed, this is the same team that wrote the report I'll be discussing today, which is titled, quote, Digital Assets Primer. Only the first inning. It's worth pointing out that the report was written by analysts at Bank of America's Securities Division. This will be relevant when we get to a few cryptocurrencies they singled out later in the report. As always, I'll give my thoughts as we go through each section, so sit back, relax, and get ready for a wild ride. The first page of Bank of America's crypto report provides a quick breakdown of the 4 areas it will focus on: the market cap of digital assets, tokenization, dApps and NFTs, and crypto regulation. All the juicy stuff here is repeated later, so for now I'll just draw your attention to the disclaimer at the bottom of the first page, which reads, quote, the firm may have a conflict of interest that could affect the objectivity of this report. This seems to imply that the authors of this report hold cryptocurrency, which I think is reasonable to assume. Now, while the disclaimer does direct the reader to the disclosures section at the end of the report, unfortunately there are no details about who owns what cryptocurrency, if any at all. After a breakdown of the sections of the report, along with an executive summary of the key findings, the report begins with a quote about blockchain technology from SEC Chairman Gary Gensler. Quote, I think the transformation we're living through right now could be every bit as big as the internet in the 1990s. Something which Gary said during his speech to the European Parliament at the start of September. Now, to me, this quote reveals the importance of cryptocurrency regulations to institutional investors, and more evidence of this can be found in the text just below the opening quote. This text directs the reader to one of the report's many appendices, in this case, the one about environmental, social, and governance, or ESG. ESG is the latest buzzword in business, and like many grandiose ideas, it was dreamed up by ideologues in positions of power at various international organizations, including the World Economic Forum. This basically involves coordinated investment by megabanks and asset managers around the world into companies which comply with ESG's ideological guidelines. Cryptocurrency is interesting in this regard because over 20% of hedge funds are invested in it, and many banks and asset managers have significant positions in crypto mining company stock. This is despite the fact that many media outlets, both inside and outside of cryptocurrency, pull no punches when criticizing the energy expended by Bitcoin's proof-of-work mining. As the authors accurately point out, Bitcoin's energy use is only a problem if you believe that Bitcoin has no value whatsoever. The reality is that Bitcoin is the most secure payment network on the planet. BTC serves as a store of value, BTC exists outside of the existing financial system, and Bitcoin mining is becoming greener by the day. These are just a few of the many qualities that make its energy expenditure worthwhile to environmentally sensitive ESG investors. On the social side, the authors argue that Bitcoin's use in illicit activity is one of a few short-term challenges which is massively outweighed by Bitcoin's democratizing effect, its financial inclusion, and lowered financial costs via the Lightning Network. The governance metrics are where things get a bit concerning, though, because the authors float FATF-style regulations as one of the measures that will bring cryptocurrency within the purposely poorly defined definition of governance in ESG. The FATF's plans for cryptocurrencies would render them anything but, and you can learn more about them using the link in the top right. So, this finally brings us to the first sentences of the first section of the actual report, which highlight the incredible size of the cryptocurrency ecosystem. Over $2 trillion of market cap and over 200 million users worldwide and counting. The authors identify the most promising subsets of cryptocurrency as being decentralized autonomous organizations, or DAOs, non-fungible tokens, or NFTs, and decentralized finance, or DeFi. They project that these niches will be hot for the next 2 decades and will take at least 5 to 10 years to reach mainstream maturity. Whereas prior technologies were often criticized for being, quote, solutions in search of a problem, this is not the case for cryptocurrency, which aims to solve a very evident problem, and that is centralized finance. Now, cryptocurrency is able to solve this problem because it is permissionless, meaning anyone can access it, open source, meaning anyone can build on it or improve it, global, composable, meaning currencies and applications can interact, transparent, because most cryptocurrency blockchains are public, decentralized, because there are hundreds and in some cases thousands of computers running the networks, and trustless, meaning there are no third parties involved in any transaction whom you need to trust. As such, cryptocurrency is a threat to many players in legacy finance, and according to the authors, the institutions that are most at risk are actively exploring how they can integrate this technology rather than compete with it. This has apparently been the case since 2019, when Facebook's Libra took the stage, and the absence of adequate regulation that this revealed made it clear to investors that more regulations were needed before they could comfortably go all in. Now, on that note, it's worth pointing out that this Bank of America report isn't exclusively about cryptocurrencies. It's about digital assets, and this includes things like central bank digital currencies and internal stablecoins like JP Morgan's dollar-pegged JPM coin. The second section of the Bank of America report provides a detailed analysis of Bitcoin. It starts off by highlighting the significance of the first commercial Bitcoin transaction in May of 2010, when Laszlo Hanyecz bought 2 pizzas for 10,000 BTC. Although BTC has been extremely volatile since its inception, this volatility is decreasing over time as adoption continues and the value proposition of Bitcoin becomes clearer to the average investor. As for the rise in value, the authors identify regulatory clarity as the biggest driver, because institutions are the only entities with the kind of money required to push Bitcoin to $1 trillion market cap and beyond. The report then pivots to the third section about the largest altcoins. They define Ethereum's ETH as digital oil and mention that there will be follow-up reports for the largest altcoins, including Ethereum, and you can bet I'll be covering those when they come out. Anyways, as expected, the institutional interest in cryptocurrencies like Ethereum and Solana is due to their smart contract capabilities, which make things like DeFi and NFTs possible. Now here is where we find the first of many minor errors, and that's the total value locked in DeFi, which the report claims was $90 billion in August, whereas DeFi Llama suggests a TVL of nearly twice that amount. To be fair, these platforms have different ways of measuring DeFi TVL. When it comes to the NFT market, total NFT sales in the first half of this year were nearly 200x higher than the first half of last year, which is absolutely insane. The watershed moment there was the $69 million sale of Beeple's NFT this March. The authors then briefly break down the stablecoin situation and confirm that the primary concern that regulators have relates to the assets that back the stablecoin tokens in circulation. If you happen to be curious about what backs USDC, USDT, BUSD, and USDP, I happen to have a video all about that, and you can find it up there in the top right. Last but not least, the report touches on CBDCs and gives a bird's eye view of where the central banks around the world are at with their respective rollout plans. China is the obvious outlier here, and it looks like its digital yuan will be fully operational by the 2022 Winter Olympics, which are set to be held in Beijing. By contrast, the European Union and the United States are still very much in the discovery phase, with the European Central Bank starting a 2-year-long decision period and the Fed also taking its time, though I'm sure they're leaps and bounds ahead of schedule behind the scenes. The fourth section of the Bank of America report is one that could have been better placed, and that's a lengthy FAQ section about cryptocurrency and any related technologies. I won't bore you with the details since it's stuff that we're all familiar with, but I will point out a few things that caught my eye. The first is the following question. Quote, why don't supercomputers dominate the mining market? Well, the short answer is that supercomputers aren't made to mine cryptocurrency. Multiple people have apparently tried mining crypto with supercomputers and found that they were surprisingly inferior relative to the standard ASIC miner at solving cryptographic hash functions. Moreover, the Bitcoin blockchain is built in such a way that the mining difficulty increases to ensure a consistent block time of 10 minutes. All a supercomputer would do is increase the network's overall difficulty, and at that point, the massive amount of power the supercomputer was using to mine BTC would make it unprofitable. What's also interesting is that the authors give a surprisingly short answer to what proof of stake is. In the aforementioned ESG-related appendix, they explain that proof of stake, while more ESG-friendly, is less secure and more oligopolistic by design. In other words, proof of stake is a pay-to-play system where the people with money are in control of the network. This makes it next to impossible for regular people to create new cryptocurrencies, since any competition could be quite literally bought out by big money and brought to a halt. This is actually something I covered in detail in my video about proof of work versus proof of stake, which you can find in the usual spot, top right. Another interesting question is answered on page 29, and that's, quote, aren't digital assets just for illicit activities? That old chestnut. Well, short answer, no. According to blockchain tracking firm Elliptic, fewer than 1% of Bitcoin transactions are related to illicit activity. 1%. To put things into context, 2 to 5% of global GDP is connected to illicit activity. Though this isn't necessarily an adequate equivalency, the implication is that fiat currency is still the dominant money in criminal circles. The next question is quite interesting, and that's what happens when the last BTC is mined. The report's assessment is that Bitcoin could survive off transaction fees alone, which they admit is somewhat doubtful. As I explained in my video about that exact topic, if transaction fees aren't enough to sustain Bitcoin when day zero comes around, BTC itself could migrate to another blockchain as a token. The next FAQ in the Bank of America report is one that's especially relevant these days, and that's whether Bitcoin is an inflation hedge. Quote, we do see some evidence that Bitcoin is more correlated with CPI year over year than gold the last 5.5 years, but more history is needed over longer interest rate cycles. At the rate that the Fed is printing money, you could argue that just about everything is an inflation hedge by comparison. The relentless money printing is why the report's projection that stablecoins could hold 5% of the M1 money supply by 2025 makes a lot of sense. The only way to fight fiat inflation with fiat is through DeFi yields. If this prediction plays out, the collective market cap of stablecoins would be over $1 trillion, which is about 8x from their current collective market cap. By that point, the purchasing power of any dollar-denominated currency will be next to nothing, though, and this ties into the next question that the report covers. Quote, how can you determine if a crypto coin or token is overvalued or undervalued? While the answer starts off by saying that there's no way of doing this, it underscores the importance of 3 demand drivers. These are use case, adoption, and developer activity. If a cryptocurrency has all 3 but is lagging behind in price relative to its peers, it's probably undervalued. If a cryptocurrency has no clear use case or developers who are working on creating a use case, then you're probably looking at a grade A shitcoin. This brings us to the 5th and 6th sections of the Bank of America report, which dish out a few facts and figures about institutional crypto trading. What's crazy is that, quote, institutional users represented less than 1% of all Coinbase users at the end of 2020, but held 50% of platform assets and contributed to 64% of platform trading volume. Keep in mind that the number of institutional investors has likely grown over the last year. This would make the statistic I just mentioned more in line with what Chainalysis found, which is that institutional investors account for around 85% of the trading volume in cryptocurrency. The institutional share of the crypto pie is likely to continue growing as well, given that an analysis of over 160,000 quarterly earnings call transcripts show a sustained uptrend in mentions of keywords related to cryptocurrency. I imagine this data is skewed by the quarterly earnings calls taking place at MicroStrategy, which holds about half of all the BTC held by publicly traded companies. The authors even go so far as to quote MicroStrategy CEO Michael Saylor, who is bullish on BTC because he can see that fiat currencies are failing. Now, the thing that really caught me off guard, though, was when the authors recommend DeFi to any readers who are hesitant about holding a volatile asset like BTC. They literally name Curve Finance as one of the platforms institutions could use for yields, and even offer a quick calculation of how much they'd stand to make. After a quick analysis of digital asset adoption in countries with high inflation in the 7th section, the report turns to explaining what Bitcoin is in the 8th section, which probably should have been done a lot sooner, in my opinion. It also addresses a question that was better suited for the FAQ section, and that's, quote, is Bitcoin digital gold? Well, the short answer is that Bitcoin is similar to gold, as it's also a store of value, quote, especially when markets lose faith in fiat currency. There is another minor mistake here, though, and that's the claim that Bitcoin hodling means BTC's price will stabilize over time. As I've mentioned many times before, if too much BTC is being hodled, i.e. not held on exchanges, it makes it very easy to manipulate its price to the upside or downside due to the lack of order book depth. This is why I believe it's likely we'll see aggressive regulations around crypto custody to ensure institutions have sufficient liquidity when trading cryptocurrencies in the future. This is just one of the many worst-case scenarios I see for cryptocurrency, and you can learn about the others by following that link up there in the top right. Anyways, one thing the authors point out is that Bitcoin and gold are not the only 2 stores of value out there. They count real estate, offshore assets, and even art in the same category. This could mean that all those overpriced NFTs could actually rival BTC as a long-term store of value, but I wouldn't count on it just yet. I also couldn't help but notice a couple of charts which show the price of BTC relative to gold's market cap at various levels. As you can see, at 10% of gold's market cap, BTC has a price of $65K. This happens to be the high we saw back in April, and this makes me wonder if this is something that institutions were looking for and why they all took profits at that level. Now, there is, of course, a commonly held belief that Bitcoin's market cap will be equivalent to that of gold, and this would put BTC in the 500 to 600K range that many crypto heads such as the Winklevoss twins are shooting for. Whether or not BTC fulfills that destiny depends on the same thing that all other asset valuations depend on, and that's supply and demand, the heading of the 9th section of the Bank of America report. As basic economics dictates, when the supply of something is limited, but the demand for it continues to grow, its price will increase. Demand in this context is code for adoption, and, quote, the main drivers of adoption are institutional investment, decreasing barriers to entry, mainly for retail investors, and growing acceptance of Bitcoin as a store of value and inflation hedge in developed economies and developing economies, respectively. This begs the question of whether cryptocurrency is actually in a bubble, as Bank of America's own analysts were saying earlier this year, and the authors of this paper address this possibility head-on. It looks like the majority of institutional investors still believe Bitcoin is in a bubble, but this number is much smaller than it was back in May, despite the price being about the same today as it was back then. I also reckon this institutional bubble analysis would be the same for just about every other asset class at this point in time, given that fundamentals are arguably more present in crypto than the companies that make up the S&P 500. This might be why on-chain analysis suggests that big investors are becoming hodlers, something which is a relatively new phenomenon. I'll just remind you that all these institutions have a different view of cryptocurrency than we do, and they've already shown that they will take profits when they meet their targets. Interestingly, the biggest risk the authors see to hodling BTC is the possibility of a flippening by other cryptocurrencies, namely Ethereum, which could happen in, quote, the years to come. Then, after explaining what the Lightning Network is and how it works in the 10th section, the report unpacks the disastrous effects that derivatives have had on the crypto market during times of volatility. As I mentioned in my video about leveraged trading, liquidations have a tendency to create an avalanche of sudden sell pressure which crashes the crypto market, and it seems that the authors agree. Section 11 is where the Bank of America report really starts to heat up, and the title says it all. Quote, Altcoins, any coin/token other than Bitcoin. After repeating a few things that were mentioned earlier that aren't even worth mentioning here, the authors then give a long list of altcoins. These are all of those listed here. Now, I'll just quickly point out that the Bank of America apparently hired a Ripple specialist in late 2019. Make of that what you will. Now, clearly, this list is a not-so-subtle signal to any institutions reading the report that they should look into these cryptocurrencies, and the selection is interesting, to say the least. It's likely that the list is meant to showcase the various use cases in cryptocurrency with the projects in those categories with the largest followings. Still, part of me wants to think that there's more to this list than meets the eye, because some cryptocurrencies just don't seem to fit, namely XRP, which is a security according to the SEC. The report then returns to stablecoins in Section 12, and in addition to repeating what was said already, the authors note that regulators could decide to classify stablecoins as securities without providing any explanation as to why. As some of you will know, my theory is that because stablecoins are backed primarily by bonds, which are securities, the stablecoins themselves are therefore derivatives of a security, albeit in a more stable form. This seems to be what SEC Chairman Gary Gensler believes. The section on stablecoins is one of the longest in the report, which reveals just how important these tokens are to institutional investors due to the yields they generate in DeFi protocols and CeFi applications. At the end of the stablecoin section, something concerning caught my eye. Quote, a recently introduced congressional bill defines digital asset securities, tokens, and gives the Federal Reserve permission to create a central bank digital currency, CBDC. The bill would also provide the government veto power over US stablecoins, as they would have to receive approval from the Fed and the SEC. This is a reference to a bill that was tabled way back in July by Congressman Don Beyer, which is currently being reviewed by various committees before being put up for discussion in the House of Representatives. Make no mistake, this bill is extremely dangerous to cryptocurrency, but thankfully it has a long way to go before it sees the light of day. I'll leave a link to a Reddit post that explains just how bad it is in the video description if you're interested. The only section that sizes up to the one about stablecoins is Section 13 about central bank digital currencies, and for good reason. As I mentioned in my recent video about the BIS report on CBDCs, this dystopian technology would cut most of the middlemen out of the financial system and leave retail banks with next to no profits. It would also programmatically limit the amount of CBDC that entities could hold or transfer for various reasons, primarily economic stability. Seriously, go watch that video if you haven't already. Now, the Bank of America report seems to not so subtly question the motivation of central banks with their CBDCs, given that the risks of the rollout clearly outweigh any potential benefits they claim it would bring. The authors then pose two critical questions. The first is whether CBDCs are a threat to the dollar's status as a reserve currency. They say no, but the answer is obviously yes, if another country like China is able to fully implement its digital yuan before the United States, and it looks like this is what will happen. With the currency completely under its control, China's central bank would easily be able to manipulate it to become much stronger than the dollar, and history suggests it wouldn't hesitate to do so. This ties into the second question posed by the authors, and that's why central bank digital currencies are inevitable. Put simply, CBDCs are inevitable because central banks will lose control of their respective countries' money if they don't develop them ASAP. You could say that this control over money is ultimately what gives governments a monopoly on violence, so losing control of it would be game over for the global elite. Conversely, a CBDC would allow them to retain this control for a very long time, possibly forever. Not surprisingly, CBDCs are extremely unpopular, and this seems to be what the authors mean when they say, quote, "No G10 central bank has committed yet to launching a retail CBDC, which ultimately may be a political decision." This is why I suspect central banks around the world are purposely devaluing their currencies, because it's the only condition under which individuals and institutions would voluntarily adopt a CBDC. If that happens, we will probably own nothing, but at least we'll be happy, right? More about that in the top right. So, finally, we arrive at section 14 about NFTs, the penultimate section of the Bank of America's crypto report. We're immediately hit with an insane statistic, and that's that visits to the OpenSea NFT marketplace increased by a staggering 120x between August 2020 and August 2021. The top-performing NFT project is Axie Infinity, and if you watched my video about it, you'll know that's not a very big surprise. The authors trace the origins of today's NFT hype to the release of CryptoKitties way back in late 2017. Now, to give you an idea of just how big a bubble the NFT market is in, the average NFT price at creation is $850, and the average resale price is over $1,700. On paper, this means you can make a 2x by minting and selling an NFT, but obviously this is much easier said than done, and this statistic is warped by big names like Beeple. According to the authors, the only regulatory concerns around NFTs for the time being are tax-related, but this is another minor mistake, as the rapid growth of fractionalized NFTs could introduce additional regulations related to securities. The rest of the section centers around NFT benefits, risks, and use cases, and I was sad to see that they didn't mention how NFTs are starting to become a cornerstone of DeFi. In their defense, DeFi is a massive sector in the crypto space that is constantly changing, and this might be why they kept things short and sweet in section 15. The authors start by bringing attention to the ease of deployment and maintenance that DeFi protocols have. Look no further than the massive contrast in firepower between Coinbase and Uniswap relative to their profits for evidence of this. Despite this fertile ground for exponential growth, Bank of America's analysts believe that DeFi won't be replacing CeFi anytime soon. Little do they know. Anyways, the authors also note the effect that DeFi has had on ETH's price and how the fee burns brought in by EIP 1559 are only increasing ETH's attractiveness to institutional investors. This is all thanks to the estimated 20 million Ethereum DeFi users that visit its various protocols on a monthly basis. Regulatory risks are also raised, and to these the authors say, quote, DeFi companies will likely need to automate certain procedures to provide user KYC documentation to regulators. The extreme alternative is for DeFi protocols to decentralize to such a degree that these demands are unfeasible, but I reckon the ideal middle ground is for user identities to be protected by default up until authorities demand to see them for whatever reason, as is done on some chains like Secret Network. Now, the final section on DeFi wraps up by detailing the 9 different niches within it, and these are stablecoins, lending and borrowing, exchanges, derivatives, fund management, lottery, payments, and insurance. The remainder of the Bank of America report consists of various appendices, which are mostly made up of information we already know as crypto bros. Even so, there are just a few details there I want to point out before I go. Appendix 2 contains a boatload of information about Bitcoin versus gold, and it notes the addition of BTC to the balance sheets of prolific publicly traded companies like Tesla as the reason why individuals and institutions have started holding it. They also show that Bitcoin's value is rising relative to gold, which is significant because most other assets have about the same historical value when they're priced in gold. The more you know. Appendix 6 covers technical analysis, and I strongly suggest you check out this section in your own time, as it has some pretty good advice. My only gripe is that the authors have the audacity of drawing a head and shoulders pattern over the price action we saw in April and May. Besides the fact that this pattern is next to impossible to tease out, we all know that what really happened back then was a Wyckoff distribution. As I mentioned in my video about Wyckoff, this is a trading pattern that reveals price manipulation by institutions, and it's found in almost every single asset market, especially Forex. I reckon the Bank of America just doesn't want to spill the beans on that one. Appendix 7 deals with Bitcoin ETFs, and it's packed with a bunch of fascinating facts. Did you know that the first Bitcoin ETF application was submitted to the SEC way back in 2013? Neither did I. Did you know that there are 20 Bitcoin ETF applications currently sitting with the SEC? Neither did I. What we did know, though, is that institutions are dying for a Bitcoin ETF of some kind and point to the success and stability of Canadian crypto-backed ETFs as evidence that the same ones could soon be seen in the United States. Interestingly, the authors note that if a futures-backed Bitcoin ETF is approved first, we may not see a physically backed Bitcoin ETF for another year. It's not entirely clear why this is the case, but I reckon the analysts know their shit. Appendix 9 addresses the state of centralized exchanges and names Coinbase, Binance, Huobi, OKX, Kraken, Gemini, Voyager Digital, Robinhood, PayPal, and Square. A strange selection, to say the least. Regarding cryptocurrency custody, BitGo, Coinbase Custody, Anchorage, and Gemini are at the top of the list. The last appendix worth pointing out is Appendix 10, which briefly covers on-chain analysis. Now, it's a shame that it doesn't go into very much detail, but it does specify 2 indicators of interest, the NUPL and the Puel multiple. NUPL stands for Net Unrealized Profit and Loss, and basically tracks how many holders of a particular cryptocurrency are in profit. The higher the NUPL score, the higher the likelihood that the top is in. This indicator can be found on Glassnode if you're interested, but do note that it's a paid indicator. Luckily, this is not the case for the Puel multiple, which is a free indicator and can be found on lookintobitcoin.com. The Puel multiple basically tracks the revenue of Bitcoin miners and pairs it with price action. As you can see, it has fairly robust forecasting features. These 2 on-chain indicators are just the tip of the iceberg, though, and if you want to learn more, you can check out my video about on-chain analysis in the description. Whew, and there you have it, folks, my breakdown of the massive Bank of America report about cryptocurrency. This is the longest video I've done to date, and I would love your feedback. So give me a like if you enjoyed it, and let me know if you want more of this kind of long-form content by leaving me a comment. Remember to subscribe to the channel if you haven't already, and be sure to ping that notification bell so you get a heads up when the next video is ready. If you're looking for something to do, check out Coin Bureau Clips, my second channel here on YouTube. You can also follow me on Twitter, TikTok, and Instagram, and join my Telegram to become a part of my crypto fam. If you're feeling lost, my weekly newsletter will help you understand. It also gives you a sneak peek of next week's video plans. My merch store is also packed with more crypto swag than you can handle. Picking up a shirt, tee, or beanie will help support the channel. Links to all these resources and more are waiting for you down below. That's a wrap for today, folks. Thank you so much for watching. I'll see you all again in the next one. I'm off for a lie down after all that.